Every time you open a financial news app or glance at the market tickers these days, it feels like a new wave of anxiety is washing over the investment world. Volatility is up, headlines are screaming about global economic slowdowns, and it is completely natural to feel a bit uneasy about your hard earned money. My name is Kunal, and over the past 20 years in the investment and wealth management space, I have had a front row seat to multiple major market cycles. I watched the world navigate the global financial crisis of 2008, and I saw the unprecedented market chaos of 2020. If there is one vital lesson those 2 decades have taught me, it is this. True, lasting wealth is never built by trying to perfectly time the market. It is built by preparing for it. At EPK Capital, our core philosophy is simple. We build wealth for generations. And generational wealth requires a strategy that does not fall apart when the economic weather gets rough. A recession is not something you need to fear. Instead, look at it as a structural event, a predictable season in the economic cycle that you can completely plan for. Today, I want to share exactly how you can build a portfolio that does not just survive an economic downturn, but actually sets you up to thrive when the skies clear. To build this strategy, we first need to understand the unique reality of recessions, especially looking at India versus the rest of the world. Right now, the macroeconomic landscape is a tale of two very different realities. Many Western economies are grappling with structural slowdowns, high debt, and shifting demographics. India, on the other hand, has a powerful shield, a massive, unstoppable domestic consumption. We have a young, aspiring population that is earning, spending, and driving economic growth from the inside out. This creates a highly resilient cushion for our domestic markets. However, as Indian investors, we cannot simply close our eyes to global events and assume we are completely isolated. In a deeply connected world, true economic decoupling is a myth. If global tech spending slows down, or if international supply chains face friction, our domestic companies feel the ripple effects. Therefore, a truly recession-proof strategy requires us to respect our local strengths while actively shielding ourselves from global vulnerabilities. So, how do we structurally design this shield? We do it by using a proven architectural model known as the core and satellite framework. Think of your portfolio like building a family home. You need a deep, unshakable foundation that holds the structure steady during an earthquake. But you also want a few spaces you can modify or upgrade over time. Now, as a bonus, I have created an in depth guide to the 7 costly tax traps for high net worth NRIs, a strategic report on avoidance and compliance. You can download it simply by clicking on the link in the description. Let's continue now. In your portfolio, your core makes up about 70 to 80% of your total wealth. This segment is filled with stable, long term, low volatility assets whose only job is to provide steady growth and compound quietly over decades. The remaining 20 to 30% is your satellite portfolio. This is your opportunistic, high growth wing, where you can take calculated risks on emerging sectors or short term market mispricings. During a recession, your satellite wing might experience some turbulence, but your core remains completely anchored, keeping your overall wealth safe and afloat. Now, let us look inside that stable core. Even during a major economic downturn, you absolutely must own equities. The secret is focusing on what we call defensive allocations, or quite simply, equities that do not quit. When the economy slows down, people might postpone buying a new luxury car or upgrading to a bigger apartment. But they will not stop buying toothpaste, they will not stop buying essential medicines, and they certainly will not turn off their electricity. This is why we look closely at sectors with inelastic demand, like fast moving consumer goods, pharmaceuticals, and utilities. These are businesses that sell products people must buy, whether the economy is booming or crashing. When evaluating these companies, both in India and globally, we look for 3 distinct traits: incredibly low debt, robust and consistent cash flows, and high pricing power. A company with pricing power can raise its prices to combat inflation without losing its customers. When you own businesses like that, your portfolio continues to generate real value even in a recession. But even the most resilient businesses will see their stock prices fluctuate when market panic sets in. That is exactly why your portfolio needs an ultimate shock absorber. And that anchor is debt and fixed income. Think of fixed income like the suspension system on a premium car. It doesn't stop the potholes from existing on the road, but it ensures that you barely feel them while sitting inside. During an economic slowdown, central banks often look to cut interest rates to stimulate growth. When interest rates fall, the value of existing high quality bonds goes up. By locking in attractive yields early using high quality corporate bonds, government securities, often called GSECs or dynamic bond funds, you create a steady, predictable stream of income. This fixed income anchor does something magical for an investor. It provides the financial stability and emotional peace of mind you need, so you don't feel pressured to sell your equities at a loss during a market dip. To add another layer of safety, we must look beyond our own borders. This brings us to the global cushion, which is all about geographic and currency hedging. Putting all your investment eggs into one single geographic basket, no matter how fast that country is growing, is a fundamental risk. By allocating a portion of your wealth to global assets, such as high quality US equities or international mutual funds, you create a natural hedge. Historically, during global economic crises, investors tend to rush toward the US dollar as a safe haven. When that happens, the US dollar strengthens and domestic currencies like the Indian rupee often experience mild depreciation. If you hold a portion of your wealth in dollar denominated global assets, the currency conversion automatically boosts your portfolio's value in local terms, offsetting losses you might be seeing elsewhere. It is a highly effective way to smooth out your investment journey. Alongside global diversification, there is one timeless asset class that has survived thousands of years of human history, and that is gold. I like to view gold not as a traditional investment meant to make you rich, but as the ultimate financial insurance policy. Gold is a unique asset because it carries absolutely no counterparty risk. It isn't dependent on a corporation's earnings or a government's promises. Historically, when fiat currencies face inflationary pressure and equity markets experience severe stress, gold shines brightest because people naturally run toward tangible security. For a truly well-balanced, recession-proof portfolio, we typically recommend maintaining a disciplined allocation of about 10 to 15% in gold. You don't own it for explosive growth. You own it so that if the wider financial system catches a cold, your portfolio has a built-in defense mechanism. The final and perhaps most important piece of this entire strategy isn't about what you buy. It is about how you manage it. It is the art of mechanical rebalancing. Human emotions are the ultimate killer of wealth during an economic downturn. When the markets are crashing, fear takes over, and our instinct is to sell everything to stop the pain. When the markets are soaring, greed takes over, and we want to buy more at the absolute top. Mechanical rebalancing completely removes emotion from the equation. It is a disciplined framework where you review your asset allocation at set intervals, say once or twice a year. If your target was to have 60% in equities and 40% in debt, and a market rally pushes your equities to 70%, rebalancing forces you to sell that extra 10% at a high price and move it into debt. Conversely, during a recession when equities drop to 50%, rebalancing forces you to take profits from your steady debt assets and buy high quality equities while they are trading at a massive discount. It systematically forces you to do what every great investor preaches: buy low and sell high. Building a portfolio that can confidently withstand a global recession isn't about predicting the exact month the market will bottom out. It is about structural design, thoughtful asset allocation, global diversification, and unwavering emotional discipline. When these elements come together, you create an investment framework that protects your lifestyle today while steadily building wealth for the generations that follow. As an actionable next step, I want to encourage you to take a step back this week and look objectively at your current investments. Ask yourself, if a major global economic storm arrived tomorrow, is your asset allocation truly balanced to handle it? Do you have the right mix of defensive equities, stable fixed income, global hedges, and insurance assets like gold? If you would like a professional, independent second opinion on your strategy, our team at EPK Capital is here to help. We can partner with you to conduct a comprehensive portfolio health audit, ensuring your wealth is structurally prepared for whatever the global economy brings next. Thank you for spending this time with me today. Stay disciplined, stay invested, and I will see you in our next conversation.